Welcome to today's deep dive. If you're tuning into the digital asset landscape this August 6, 2026, you're probably sensing a pretty massive structural shift.
Yeah, you really are. It's not just noise right now.
Right. Our mission today is to analyze Bitcoin's current price stabilization, this huge pivot in mining economics, and, how global regulations are really shifting underneath it all.
Exactly. I mean, if we look at the market stabilization, Bitcoin is rebounding near $64,500, but that's not happening in a vacuum.
No, definitely
We
not.
just saw a 4% drop in global oil prices, and U.S. Treasury yields are finally cooling off, so that's injecting a lot of liquidity into risk assets across the board.
For you listening, I think it helps to look at Bitcoin right now as this sort of high beta sponge. It's just soaking up global fiat liquidity. It acts way more like a Wall Street macro proxy than some isolated rebel asset.
That's a really good way to put it. And you see that exact dynamic in the ETF momentum. I mean, spot ETFs saw $244.4 million in inflows just yesterday.
Wow, just yesterday.
Yeah, and BlackRock's IBIT commanded like $196.8 million of that alone. So the institutional appetite is just relentless.
But, while Wall Street is aggressively buying up the supply, the actual corporate operators are totally shifting their strategies because their margins are incredibly tight.
They have to. You look at MicroStrategy, right? They're playing strict defense right now. They padded their fiat reserves to $3.75 billion, but they're keeping their stash of 847,363 Bitcoin completely static.
Right, just holding the line. Whereas you have Block Inc., on the other hand, leaning into a highly profitable transaction fee model. I mean, they saw a 31% year-over-year surge in Bitcoin gross profit.
Yeah, the contrast there is fascinating, but the real AI exodus is happening with the physical miners. The pivot there is just massive.
Or the TeraWulf situation.
Exactly. TeraWulf now generates 71% of its revenue from high-performance computing, or HPC, and that is heavily driven by this $33 billion Anthropic lease.
Wait, 71%? So they're barely even a Bitcoin mining company anymore.
Basically, yeah. Because the economics are just brutal if you don't switch. HPC yields up to like $3,500 per megawatt hour. Traditional mining, you're looking at just $120.
It's an absolute no-brainer for them to switch. But I have to push back a little here.
Yeah.
If public miners are committing $70 billion to AI data centers, doesn't this mass exodus leave the network dangerously centralized?
Well, yeah.
Like, it seems to me just leaves a few ultra-efficient hardware holdouts actually running the network.
That is the big analytical takeaway here. It absolutely concentrates the hash rate. The physical infrastructure is fundamentally shifting. And, at the same time, the digital infrastructure is facing this tightening compliance squeeze.
Right. A really complex regulatory web globally. Like Russia's new law.
Yes, that's a perfect example. They just passed a law permitting cross-border crypto settlements explicitly to bypass international sanctions.
They're still cracking down at home, right?
Exactly. They capped domestic retail buying at roughly $3,700 annually.
So question for you. If Russian UTXOs, those unspent transaction outputs, start moving around for state-level settlements, how do Western asset managers safely operate?
It's incredibly difficult.
Because if those sanctioned UTXOs start polluting the blockchain, aren't Western funds violating sanctions just by holding mixed assets?
That is the exact nightmare scenario compliance teams are trying to solve right now. It's why the U.S. SEC just launched a new financial reporting unit. They are specifically enforcing fair value mandates and watching these flows.
And on top of the regulatory side, the technical security is getting hammered. I mean, the Bitcoin Red Team just found 85 open source security flaws following that $88.6 million cold card exploit.
Yeah, the supply chain for the software itself is under immense pressure.
So just to summarize the reality of where we are on August 6th, Bitcoin is operating 24/7, but it is a highly scrutinized, fully corporatized asset now.
Completely. The frontier days are definitely behind us.
Which leaves you with a really provocative thought to end on. If mining power is continuously diverted to AI, and Wall Street ETFs just lock up all the remaining supply, who actually dictates the future consensus of the network?